Hello and welcome to a brand new show of IRM, or show on which we ideate and debate and understand that what could essentially happen to the Indian economy and what can be done to bring India back on the revival path. It gives me great pleasure now to bring on board Mr. Sanjay Agarwal, Managing Director and CEO of AU Small Finance Bank. Sanjay, good morning. Thank you for joining us. Sanjay, I'm going to first understand your view on the economy, especially the area which you represent, which is the MSME and SME space. Given that the pandemic has been rather, the pandemic has had a crushing blow on that end of the economy, how strong the revival has been?
So Nikunj, you're absolutely on the spot that, we all thought that in the quarter one, the kind of lockdown we all witnessed, these MSMEs and SMEs would be, hardest hit. But to surprise to us, especially for me, because these customers actually is a marginal customer with the marginal sectors, with a lot of leverage, not having that whole business plan in place, but they all survived, sustained, and and now giving up. So, and the kind of recovery we saw in the month of from October, November, December, the quarter three, and now till now is really amazing. In terms of collection, in terms of growth demand, and not only it's not people are saying it's pent-up demand or whether it can sustain or not, but the way we are talking to customers, they see a lot of growth happening in next maybe 2-3 quarters. So a lot of energy has come back, a lot of confidence has come back, not only to them, we also, because we also were not knowing that how will they actually will come back. So very pleasant surprise in last 2 quarters.
The money which you've raised via the QIP, how much of that will be used for growth capital?
So it's a growth capital, Nikunj, because we are north of 20% in terms of tier 1 capital, and we were supposed to raise last year, but because of pandemic we postponed it, and now as we are witnessing that we are growing north of 20% this year, north of 30% deposit growth. So personally, I believe that there would be a lot of growth available maybe after 2-3 quarters. So want to really strengthen our balance sheet and build some fuel internally so that when right time comes, we are there to fire.
So what you're confirming to us is that bulk of the write-off which you had to do because of pandemic, which you did with your Q2 numbers and Q3 numbers, that's behind us?
Early to comment, Nikunj, because I still believe that, we all had to take care of another 4 quarters. So 21, 22, we really need to see that how the whole restructuring book or we actually provided emergency credit line, the kind of NPLs we are seeing it, till quarter 3, has to really see the outcome also. So largely, I would say we have largely covered it, but still there is a 10% kind of dilemma still there, right? So really want to remain cautious that, for next 4 quarters, so 21, 22, and then the final comment that, how really the next 5-6 years of growth can happen in India.
A lot of MSME and SME have also benefited because of the government guarantee schemes. And IBC right now is not there. So you don't know what the true picture is. Once the credit guarantee schemes, the effect of that starts fading away, the IBC laws, they start kicking in. Could the picture be different?
No, I won't say, because the credit goes to RBI, Central Bank and Government of India to, give us all those ammunition, right from moratorium, the refund of interest and interest, emergency credit line, restructuring, because without that, you won't have been able to survive, right, or sustain. So it's not so negative, honestly, because a lot of people also took money to really safeguard their business, I'm not sure how many were really needing it, right? But it's the way we handle this pandemic, once in lifetime. So I would say, let's see how the next 2-3 quarters pans out, but I'm not too negative around it.
Some of the areas where you have historically given loans, let's say in the vehicle finance business, also in the non-salary class businesses. Sanjay, let's be clear that apart from MSC, individual job losses have happened. Now, some of those jobs which have gone, they've not come back. and yet nobody is feeling the heat. If somebody has lost a job, there would be some implication for a bank or a credit company. But when I look at the numbers are telling me a different story. The numbers are job losses have happened, and credit or the balance sheet of credit is not broken.
So, fortunately for us, Nikunj, we are more into self-employed space. Our 90% customers do their own business, right? So we are not facing that challenge that because of job losses, we are getting NPLs. And it was a temporary break in quarter one, quarter two, but with a strong comeback, our collection efficiency is more than 100%. So I'm not sure that which class, which bank, which book is getting pressurized because of job losses. So I'm unable to comment there. But our customer segment has given us strong resilience and has strong comeback. So we are very comfortable around those things.
Which you enjoy are one of the highest in the industry. That's been your hallmark ever since I've started interacting with you and we've understood your business model. So I'm saying the NIMs which you enjoy is the hallmark of AU Small Finance Bank. Your NIMs are the highest. In this kind of an environment of abundant liquidity, can you sustain these NIMs, these net interest margin numbers for a long period of time?
No, of course, Nico, there is an abundance of liquidity, but there is always a caution around credit, right? So, and AU has done, not doing from last 3 years, we are doing from last 25 years. So we know our segment, we know our opportunities, and a bank platform, our cost of money has gone down by 250 basis points in last 3 years, right? And that the whole benefit has gone to the customer only. So I strongly believe that, the model we run, and the agenda which RBI has given us, the whole framework, is also to get deposits from urban markets and to lend to the core market, which is the semi-urban rural market. So, and because a lot of NBFCs are not there, a lot of HFCs are not there now in the last 2 years, so the ample field is open up, right? So I don't think that we'll have a challenge around our NIM for maybe next 2-3 years, so pretty comfortable there also.
Okay, fair enough. What's the kind of growth prospect in terms of numbers now going forward? The outlook, of course, is clearly sounding positive. Are you looking at double-digit growth, the kind of segments as well that you see really supporting that going forward?
Yes, so we are into those assets, which we are doing from last 10 years, whether it's vehicle, MSMEs, SBL, home loans, so business banking, and our size is so small, honestly, that if the conditions remain good, which I am actually feeling that maybe 2-3 quarters down the line, you will see very strong comeback at our economies. So I don't think that banks should be worried about their growth. For me, it's more about governance and innovation nowadays. So that will lead to the whole story of AU. So, I don't want to put any number around it, but you can see the way we have grown in the pandemic year itself. Our asset will growing north of 20%, our deposit is growing north of 30%. Our NPLs are around 3%. So that gives us a lot of comfort and confidence that once the things will settle down, the growth will come back.
Okay, any further capital raising as well that you'll require in this year itself? How long is the current capital expected to last?
To be very honest, given a choice, I would have raised more, but you know that as a promoter, I have to have 26% at least holding till April 22, which is our 5-year completion as a small finance bank. So post that, my limit will not be there. So would be raising more money, maybe next 18 to 24 months. But as of now, very comfortable around our capital adequacy ratio.
Okay, so post this and considering 9-month profits, capital adequacy, I think tier 1 capital adequacy stands at 20.3. Post QIP, what will be the tier 1 and the CAR total book value per share as well as the ROE impact?
Oh, sorry. So, I would say my capital tier 1 would be north of 22% as on 1st April. And I think I can't comment on ROE and ROE as of now, but because it's a diluted effect, I don't even remember my share price, per share. So I'm sorry, this answer has to be done by CFO.
Fair enough, Sanjay. I'm putting you in the spot, asking you for all those numbers.
It's all right.
Also, in terms of the total amount raised now, I mean, we're looking at a report suggests 600 crores. And what is the kind of dilution and what's been the investor response? Share with us some of what you've really heard back in terms of feedback from investors and what they're looking to see more of, or even any areas of concern.
So it's our first QIP, right? Because we had IPO in 2017 when we have a preferential share with Temasek in 2018. So it's our first QIP. Team has done tremendous job in last 2 weeks. We got immense response from across globe. Right from capital to GIC to even a domestic one like SDFC Life and so many, So I'm really thankful to everybody there to support us. The feedback is very honestly, always say that AU is expensive, which is not in my hand. We as in management always want to go and, express ourselves on the field to build a very, tech-led retail franchise for this country. So very humbling experience, and we priced our QIP at 1251, and I believe that the entire investor base which we got into this QIP, will be enjoy this franchise as we move forward. Largely it's done by Capital, GIC, SDFC, Birla, so that's the color I can only give you as of now.
Perhaps anything more you can describe to us in terms of what's in store, in terms of the plan, the strategy?
Yeah, so very exciting time, to be very honest, because we all came out from this one of its own kind of event, in lifetime. So feeling a lot of more confident, to build AU to next level. A lot of focus is on digital, how we can actually transform ourselves from a physical-led bank to a tech-led bank. A lot of new properties we are working, whether it's in QR code, video banking, so brand around AU. And so quite excited to see the space evolving around us, and I believe that this decade, AU will come to the next levels. We have come so far, right? But there's enough massive runway available for us to have a growth for next 10 years, So, and I'm really thankful to the way the RBI actually handled us in last 1 year, whether it's by supporting us liquidity, by providing us a lot of input to how to handle NPLs and all those things. So, quite comfortable and very, very positive to see how India is also coming up, so everywhere there's a lot of exuberance, a lot of positivity. People are actually talking about to build business, build their life, unlocking the potential. So, and bank has to play their role, right, to stitch all those things to really have a very decent outcome. So, very happy to run a bank like AU as of now.
So how far, Sanjay, from the plan or dream to make AU a universal bank?
So, I'm very happy as of now because RBI has mandated us to run like an SFB for first 5 years. So we are completing our 4th year next month. So, and what an amazing platform, to be very honest, because you have the ability to lend to the core markets or to the unserved, unreached market with a liability franchise with you. So happy to take it for 1 more year, and then believe that once we achieve our 5 years, the board has to take decision whether we want to really continue the SFB or we want to go to universal. So long way to go. So let us see how we actually work for next maybe 1 year or 2 years, and then take the call.
Right. Also, Sanjay, wanted to understand that, do you think not having a holding company structure, unlike, say, an Equitas or an Ujjivan, will actually manage to smoothen the process towards a universal bank further?
So I'm not knowing all those challenges because of holding company because I started this company, without all those things in mind. We actually were building this small company, and suddenly we got the license, right? So it's a very simple structure in AU. Me and my family hold in their personal name this whole holding, and then of course the investors are there. So very, honestly, last 4 years we haven't found any issue around RBI. So whether it's in shareholding, whether it's an overall the shareholding structure or a ratio or whatever, right? So of course, if you go to an RBI or a central bank without putting them into a complex situation, it's always good. So I'm very happy the way we built ourselves in last 4 years.
How the asset quality trends are shaping up, and would you have to continue to provision more and more?
Very difficult to answer as of now because sometimes it's driven by how and what much of PCR you really want to build on, right? As of December, our PCR is north of 60%, and we do all secured. So we don't do personal loan, we don't do microfinance, we are not into an asset class which have been badly impacted, right? So I strongly believe that we have already covered ourselves very well, but still we want to remain little caution around maybe 2 quarters more and then see. But if you ask me that, Sanjay, how confident you are, so I would say I'm pretty sure that we won't require any more further provisioning.
Okay. On that happy and positive note, Sanjay, we let you go. Great to have you on the show today, and thank you for so candidly chatting with us.
Thank you so much. My pleasure.